Hello and welcome to our group's presentation on a strategic analysis of Target Corporation. We are going to be beginning off with Marina on an introduction to Target.
I'm just going to go over just the basic just business model and mission statement of Target. So next slide, please. So the mission of Target is to help all families discover the joy of everyday life, and they make a promise of surprises, fun, ease, and inspiration at every turn, no matter when, where, or how you shop. When it comes to applying the mission statement to the business, there are two important questions that need to be answered. Is it aligned with the actions of the company, and is it in harmony with their business model? Next slide. To make shopping easier for their customers, Target has locations across 50 states in the US, and 75% of individuals have a Target store within an easy reach. To allow their customers to shop in whichever way they would like, whether they are at home, in the store, or running errands, Target has invested money into their marketing strategy to allow for advertising through social platforms, media broadcasts, and newspapers. This way, customers can take advantage of shopping online for the convenience or going to the store in person and getting the item right away. This goes hand in hand with their business model because through the expansion of their social platforms, customers can shop when they want, where they want, and how they want. Target also partners with designers and brands to launch an exclusive range of products, which allows them to fulfill their promise of surprise, fun, and inspiration, where customers are able to see new designs and products so as to keep them coming back to the store. Next slide. The business model of Target is subject to imitation, given that Walmart and Amazon have their own private label brands, much like Target does. It's hard for Target to distinguish themselves in this area only. However, Target does have some advantages in their social platforms area, as mentioned before. In 2020, Target did spend about $1.5 billion on advertising, which is less than some of their competitors. However, they do use a variety of techniques to try and reach all of their customers. Next slide. In terms of sustainability, the Target business model is sustainable because of the few following reasons. So Target has about over 1,800 stores throughout the US and 41 distribution centers to support these stores. They also beat out Walmart in gross profit and net margin, which is impressive considering that Walmart has more private label brands and significantly more stores than Target. And finally, their continued focus on e-commerce allows them to adapt to the growing technology today and bring in more customers to their stores and website.
All right, so now taking a look at the external analysis of Target, I'm going to start off with Porter's 5 forces. So starting off looking at threat of new entrants, this is deemed to be quite high. There are not many barriers to entry when it comes to retail stores in general. It doesn't take unique capabilities or any sort of patented technology to have a retail store. The concept of retail stores can be started at very low level without much capital adding to that threat. Legally, it's quite easy to start a retail business, and the requirements for starting one are not high. There are no unique skills needed in the retail business either to help companies stand out from the rest. The constant growth of the retail industry, especially in the US, is another factor that has caused a lot of new entrants into this market. Total retail sales in the United States are projected to be around 5.94 trillion in 2024. This would be up from 5.47 trillion in 2019. Along with the pandemic, has put a halt to opening a lot of retail stores due to uncertainty. But once the pandemic gets under control, it's estimated that there will be a lot of pent-up demand for new retail stores opening, increasing the number of new entrants into the market. Next slide, please. So next, looking at the power of suppliers, this is deemed to be quite low, as big retail chains like Target and Walmart have great influence and power over their suppliers. Suppliers are very dependent on stores like Target, and therefore they don't have much power or say when it comes to supplying stores like Target. None of the suppliers are large enough to hold any influence over Target as well. Along with this, the number of suppliers in the retail industry is very large, and that reduces the pressure on Target as they have many different suppliers to choose from. Target has a variety of products for sale in its retail stores, which allow for no single supplier to be responsible for over 5% of the company's total sales. This effectively gives the suppliers little power over Target. And then looking at power of suppliers, this is high. When it comes to Target and the overall US retail industry, in general, the bargaining power for buyers is high. The switching costs of the customers is very low from one retailer to another, which increases the buyer power even further. The US retail industry has a vast number of stores, and the customers can buy from any of those stores without having really too many extra costs or benefits of choosing one over the other. Next slide, please. Then looking at threat of substitutes, this is pretty high. Even though retail is in need and the products cannot be sold without retailers, the form of retailers has, however, been changing as there's strong emergence of e-retailing, which has had a huge impact on physical retailing. But this is more of an alternate than a substitute for retailing. We can see companies like Target and Walmart have bolstered their e-retailing platforms to capture new emerging markets. Target has seen 118% e-commerce growth in Q4 of 2020 compared to the Q4 of last year. Products such as groceries and electronics are largely undifferentiated among retailers. Customers can easily switch between companies without incurring significant switching costs. And then looking at the competitive rivalry as a whole and taking into account all the past forces that I just talked about, the competitive rivalry of the overall industry is very high. There are several large players, and even the smaller players do pose a competitive threat. The main competitors of Target include Walmart, Costco, Amazon, eBay, and then Target Corporation operates in a very competitive discount variety stores industry. This competition does take a toll on the overall long-term profitability of the organization. Next slide, please. And then looking at opportunities and threats when it comes to SWOT analysis, Target has great opportunities to partner with companies to promote future growth. One partnership they did in the past was partnering with CVS Health. This means that Target's pharmacy section is managed and operated by CVS Health and gives both companies great opportunities to offer retail alongside healthcare. This is something that they could look into in the future for future partnerships in their stores. Target also has a great opportunity to expand its Red Card loyalty program, allowing it to gain insight about changing customer habits and their preferences. And then they also have same-day delivery. Target has acquired a grocery delivery service Shipt for $550 million to provide same-day delivery. And this is something that they can also expand upon. And then lastly, expanding their private label brands. This is a key opportunity for Target to develop their own portfolio of private label brands and continue to expand upon these. Next slide, please. And then lastly, looking at threats, Target operates in a highly competitive industry, as previously stated, often met with low margins. The biggest competitors that are a threat are Kroger, Walmart, Costco. Each of these competitors have numerous stores that can be found across the country. This makes it hard for Target to stand out from its competitors. The change in customer preferences has severely impacted Target's business model. There's been intense negative impact on Target due to growing demand for online shopping caused by COVID-19. Companies such as Amazon have gained market share in the industry because they're able to quickly adapt to growing online shopping markets. There's also a failure to differentiate Target from its competitors. All grocery stores are pretty similar, and shoppers may opt to go to stores with the lowest price. And then finally, the last threat is the retail business in general is very easy to replicate. Any new emerging company in this area has the ability to sell similar goods to Target, and competitors can also undercut Target's prices to take away market share.
Thank you. And I will be taking over the internal analysis portion. So starting from the top of the value chain, we're going to be starting with firm infrastructure. Target is largely pretty standard when it comes to the firm infrastructure. I did find it important to note they do have a pretty heavy emphasis on their legal department. This is a result of the times that we are in. Target has an enormous amount of data on its customers, and because of the emerging laws that are coming about with big data, with data on their customers, they do seem to have a bit more of an emphasis on their legal department, which is good. Therefore, we're thinking about potential lawsuits that come just by nature of having being in the industry. So aside from that, they do with their human resources management, they did have a very heavy emphasis on succession planning, which I found interesting. Them being such a long-lasting company, they do clearly seem to have a plan for lasting through the generations. They're always focusing on getting the next employee primed for the next management position, which I thought was a very good conservative approach for a long-lasting company such as Target. Moving on from that, actually, it's also important to note they do focus very heavily on employee satisfaction. You're going to see this come up in just a few minutes. Again, they do have a lot of internal programs that are focused on mentorships. They do focus a lot on retaining that talent. For the technology development standpoint, something very exciting has been going on for Target in the past just 3 to 5 years. They've been focusing on implementing a new emerging inventory management system. This is designed to bring the inventory costs that Target incurs drastically reduced. We're going to get into the details of that in just a few minutes, but this is a pretty big development for Target in terms of their technology. Next slide, please. So the logistics, moving into the procurement section of the value chain, their logistics is very interesting. So this is what I was just talking about with the technology development. This new system is focused on reducing the cost of getting goods to the consumer. So the Target for the items that are now registered in this new emerging inventory management system, a lot of the goods are no longer shipped in massive loads of goods. Now, an order comes in for Target solely for the items that it needs. So perhaps they're no longer ordering 20 boxes of shampoo. Perhaps they only need 1 box of shampoo, but they also need a box of cereal to go with it. So it's much more reactive to the needs of the consumers, not so much so focused on the large quantity orders. This has been able to reduce a lot of Target's costs for the, I believe it's 1/3 of total products that they sell are now registered in this system, and it's been very successful at reducing those costs. Additionally, Target does have a subsidiary called Shipped Inc. Now they bought this company and they deal with a lot of the shipping requests for those digital orders. So although I believe it not very much of Target's total sales comes from the digital realm, those that do are largely fulfilled by Shipped Inc., their subsidiary. And if they are not fulfilled by Shipped themselves, they are fulfilled by the vendors. And in that case, Target is kind of the intermediary between that supplier and consumer. So there's even less cost for them in that case. Moving on from that, the operations standpoint. So Target obviously has a enormous variety of items that they sell, everything from grocery to technology to consumer goods, housing, bath and kitchen and everything like that. So they do have a very large variety of items that they sell and look to stock frequently and reliably. Now, one thing I did not know that I found very interesting was 1/3 of sales of all of Target's corporation come from brands that they actually own. So Target has been working to acquire brands and build their own, which is a very good sign for the future. As the reputation of those brands grows, the margins that Target may be incurring can be higher in the future because they own 1/3 of those sales. Next slide, please. Now, marketing and sales, this is also very important because this is largely what Target tries to base itself off of, offering discounted prices with a differentiated shopping experience. So Target stores, they try not to look like Walmart's. They try not to look like lower or cheaper options for shopping. They try to keep the aisles very clean. the store is aesthetically pleasing, and they do put a lot of emphasis on this, more so recently, just within the past about 7 years or so. Target also focuses very heavily on believing it's the people that shop there are guests, not customers. So they try and really focus on providing this experience to customers in a market that is going more towards digitization. So more shopping is being done online, but Target is focusing on that in-store presence and making it as preferable as possible to their guests. And finally, the final section of procurement service. So how does Target continue to provide value to customers, keep them coming back, and improving the quality of what they're offering? They do focus very heavily on the shopping experience. So they, just in 2020, Target renovated just shy of 10% of its stores nationwide to give that good appeal, the aesthetically pleasing appeal of the store to its customers, and it does pay a $15 minimum wage to its employees to keep the positive atmosphere up in the Target stores. Next slide, please. Now, its distinctive competencies and strengths that Target has. Number one, the differentiated shopping experience. This is not cheap to have. The renovating of stores was a pretty somewhat risky move because of the digitization of the industry. Target took it, and that's not something that's so easy replicable that you would expect tomorrow another brand to go about renovating their stores for the next 10 years. That is one of their strengths, is that differentiated shopping experience. People think of Target in a positive way for that reason. The breadth of the products that they offer is very, very difficult to manage because of the complicated distribution system Target has access to. The inventory management and distribution processes that I discussed, that new emerging inventory management system is something that could save Target a significant amount of money, saving on restock options, saving on back order costs. And that's not something that's super easy to come up with. So Target over time has developed this. This is a strength that they have. Next slide, please. Weaknesses for Target. So the high cost of shopping centers amid digitization, Target has a lot of money invested in its in-store presence, and that is kind of a sunk cost that Target does have to deal with in this industry that's going towards the Amazons of the world, towards the digitization. Target does have to deal with its massive amount of capital it has in these shopping centers. It is also not present internationally. It is primarily focused in its domestic operations here in America. That is a threat. Or that is a weakness because they cannot reap the benefits of those international markets. And finally, they are undiversified in gas stations and financial services. You will notice, for example, BJ's, Walmart, Costco, they tend to have gas stations at their stores. Target does not. Walmart is experimenting right now with bank-related services. Target has not fully entered that market. So they are weak in that area.
So next we'll be focusing on ratio analysis, which is more of like looking at their numbers and financials to see how they've been doing with their new strategies and with their strengths and weaknesses. So I kind of broke this down into 5 different categories. You have the liquidity ratios, which kind of focuses on the ability to use cash or quick assets to extinguish current liabilities. Then you have activity ratios, which are used to determine efficiency of the company's operating assets. So you can see there's accounts receivable, inventory turnover, how quickly those will turn over and how many times they will per year. Then you have profitability ratios, which is just kind of showing how profitable the company is within like the year. You have return on equity, which is just how profitable they are in terms of equity. And then solvency, which just focuses on the ability to meet future obligations and liabilities. So for the activity ratios, there wasn't that big of a difference between year to year, but I like to focus on the liquidity ratios, specifically current, quick, and cash. As you can see, current ratio went up 16%, quick went up 85%, and cash even went up 130%. This is like very good for Target as they're improving all their stores and having to deal with COVID-19, having more cash on hand or cash equivalents where they're easily be able to convert it to cover those current liabilities. They're able to respond to changes much quicker, especially in this COVID atmosphere where you kind of never know what's going on in the future. Having that cash and the ability to cover any liabilities or anything quickly is very good. And then next in the profitabilities, you can see their basic EPS and diluted EPS both went up 36%. I mean, it's easy to see that the earnings increased this year drastically to go up 36% in a year where many businesses were drastically impacted by COVID. And then the next good thing is in their solvency ratios, they had long-term debt to equity. It went down 17%. This is a little tricky because their long-term debt did not decrease. It stayed relatively the same from year to year, but their equity actually increased. So this is very important because, the long-term debt remained the same while equity increased. So now they're able to decrease this ratio, which business wants to get it as low as possible because then you have less debt and you have more equity in which you can maximize your leverage in terms of having to pay this debt. So having this drop over 17% in 1 year, as you can see, 95 to 79 is very good for Target. Next slide, please. Next, it was just focusing on the condensed income statement and just showing the drastic changes in revenues. The right side kind of breaks down how their revenue is calculated with sales. You have other revenue, then their cost of goods sold, other expenses, and you get down to net earnings. So from 2019 to 2020, Target saw a drastic increase in revenue, operating income, and net earnings. Revenue went up 20%, which is very significant. That's over $15 billion of revenue. Their operating income went up 40%, which is also very, very significant. And their net earnings at the end of the year were up 33% within a year. This is very, very good considering you had COVID again, impacted a lot of businesses. However, with this, expenses increased 20%, but because their expenses were only $54,000 for cost of goods sold and $16,000 of selling and general admin expenses, 20% of increase in expenses is significantly outweighed by a 20% increase in revenue. So this is a very good sign. And obviously you can see with their operating income and net earnings that it positively impacted them. Next slide. So then in terms of how their financials compared to their competitors, we've already mentioned that Walmart and Costco are kind of like in the same business and big competitors of them. In terms of their gross profit margin, it was 29.27%, which is significantly better than Costco and better than Walmart, which is a good sign to see that whenever Target makes a sale or anything, they're making more profit on that sale than their two competitors are. And then in terms of this helped them generate, as previously said, a 20% increase in revenue and 33% increase in earnings, while Walmart only had a 7% increase in revenue and actually lost 10% on their earnings, and Costco had a 15% increase and only a 2% increase in earnings. So although in a crazy year with COVID and everything's impacted, you can see that Target was able to significantly increase the revenue and earnings much more than the competitors, which is a great sign to have going forward. But we do have to be careful because although their financial metrics are heading in the right direction, they do need to develop a tech-savvy approach to cater towards online retailing. With COVID and everyone staying home, online retailing is becoming more and more apparent and more pleasing to a customer. So taking your revenues and your increased earnings this year and maybe investing it towards developing just a better online experience, even though they can still focus on their in-store experience. Just being able to develop that online experience would have them maybe take a little more revenue away from Amazon and Walmart, because those two are really dominating the retail, online retail business right now.
All right, so now we're going to be looking at a portfolio analysis of Target and how it compares against its competitors. So looking at these two revenue tables here, I took Target's financial information from 2014 and 2019, and I compared it against its two biggest competitors, which are Walmart and Costco. And I segmented the products into 5 different categories, which are household essentials, hard lines, apparel and accessories, food and beverage, and home furnishing and decor. And I think an important thing to note from this is that Walmart is a much bigger company than Target and Costco in terms of their total revenue. So I think this is going to be something that comes into play very heavily in the portfolio analysis. So looking at the BCG growth matrix here, it shows the relationship between their 5-year growth from 2014 to 2019 and their percentage of relative market share. And it segments them into 4 different categories, which are stars, question marks, cash cows, and dogs. So looking at Target's BCG analysis, you can see that food and beverage and hardlines are both in the dogs category, which is expected when competing against Walmart and Costco, who specialize in their food and beverage sales. And you can also see here that household essentials and apparel and accessories are in the stars category. Meanwhile, home furnishing and decor kind of floats around the middle. Moving on to Walmart, this is like I mentioned earlier, since Walmart is such a big company and they have much more total revenue as compared to Costco and Target, they have 100% relative market share all across the board here. So this is something that I don't think is the greatest method of comparing Target to Walmart. But this is just to show that Target or Walmart is a much bigger company in terms of total revenue compared to Costco and Target. Then moving on to Costco's BCG analysis, as you can see here, they kind of suffer the same pitfalls that Target faces because Walmart's so big. Their food and beverage sales kind of float towards the dog section of the BCG matrix as well as hardlines. However, they do also have good relative market share in household essentials and apparel and accessories. Those are in the stars category. Moving on to the product mix, as you can see from the revenue tables earlier, Target specializes in having a diverse product mix, and that shows because their revenue is spread relatively even across all categories that are in the BCG matrix. And then their highest source of revenue is their household essentials, which includes beauty products, cleaning supplies, and so on. And this is something that you can kind of tell when you go into a Target store, is that they have a lot of their beauty supplies and self-care products kind of on display towards the front of the store. And then finally, their main competitors, Walmart and Costco, obviously specialize in their food and beverage sales, and that's where the majority of their revenue comes from. And that's why you're going to see Target in the dog section of the BCG growth matrix. And then for their geographic part of the portfolio analysis, like Nick said earlier, nearly all of Target's revenue comes from the operations in their stores, which are only located in the US. Meanwhile, Walmart and Costco operate in all the major continents across the globe. I would say that an opportunity would be for Target to expand internationally. However, they did try this already in the early 2010s. They tried to expand into Canada by opening some more stores. However, their success wasn't what they wanted it to be, and they ended up unfortunately closing all of the stores. Target CEO Brian Cornell did an interview with Yahoo Finance, and he said that because of that, he doesn't plan on doing any more international expansion. He wants to stay competitive domestically against Walmart and Amazon. So going off of what Chris said, I think that the best thing for Target to do would be to increase their online presence, especially with everything that's going on in the world right now, and online retailing seeming to be the direction that a lot of companies are taking. It would be a pretty big thing for Target to increase their online retailing presence.
So the next section, we're going to talk about our strategic recommendations. Next. So the main one that we came up with was for Target to consider adding gas stations. This is a good idea because grocery and consumer good chain stores all over the US have these, even their competitors like Walmart, BJ's, Costco. And it works well for Target because in 2019, 90% of their sales were from in-person shopping. So that would create more opportunity for people to get gas while they're shopping. The main advantage of this would be to increase the number of trips made to the store annually. They cost $500K to build on average, which isn't that much of an investment. And we figured out that the trips to Target that people would take annually would increase 10%, and their post purchase of gas would be around $35. And with this information, we figured that the payoff period for one gas station is less than 4 years. There would also be a 5% increase in store revenue from this and a 24% ROI over 5 years. And we're going to show you the model we use for that in the coming up slides. So you can go to the next one. So for our model, we'd have some key assumptions. The first being that the average bill spent at Target is $62, and the average bill for going to Target after getting gas there is going to be $35. We also said that gas stations increase the number of trips to Target by 10%. This percentage is also an assumption, but it seemed pretty reasonable. We also came up with the assumption that a gas station would cost $500,000 to build. This was just based off of market research of gas station prices to build. And we also said that Target would have to be a price leader with their gas prices. This wouldn't be a main revenue driver for Target because the margins for gas is pretty low profitability. So their main purpose in gas stations would be to get more foot traffic in the stores, considering that's where most of their sales come from anyways. And the next slide you can go to. This shows the NPV calculation, and we started with the increase in revenue per year. This is based off of the key assumptions that I went over, and then we multiplied that by their earnings conversion, and this earnings conversion is their net earnings divided by their total revenue, which is only 4.67%, but they do bring in a lot of sales, so it still ends up being a big number. And then that gives you your cash flow per year, which you can see. And then we use the formula to get the NPV. And then as previously stated, that gives you the ROI of 24.4% for 5 years. That wraps up this presentation. Thanks for watching. Hope you learned about Target.